All right. Hello, everybody, and welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian, and I'm here with Renji Matthew, as always. And today we're going to be talking about controlling your money and why you need to be in control of your money. Because if you're not in control of it, then who is? Because there is somebody that is, and you don't want it to be the government. You don't want it to be your debtors, your lenders, people you're borrowing money from, but it should be you. Right? So that's the conversation and what we're going to talk about today. And we'll probably break it down into different parts, like how you can control your money now, maybe while you're working, and then versus like how you can control your money later for retirement. Because in retirement, I can't tell you how many times we run into people that just, you don't know what you don't know. Right. And there's so many better things that you can be doing to manage your money, to reduce taxes and increase income when it comes to retirement as well. So Renji, go ahead and get us started. Let's talk about, what are some things that people can do to control their money now for them?
Yeah, so what do most people do? Right. Most people do, they put their money into 401ks and IRAs, which nothing wrong with that. But one thing that when it comes to controlling your money, what a lot of people don't think about is taxes, right? Most people put money into tax deferred accounts because their financial advisor or CPA said, hey, you're going to get a tax break today. So keep putting money into these. The more money you put into that, the less you get taxed on it this year, right? But what they don't think about is it's kind of taking a loan from the IRS, right? Because if you're actually getting tax deduction, what is a tax deduction, right? So in a business or something, if let's say you spend money on a printer for your business because you need to print a lot of papers out, right? That printer, let's say it costs, this is a really nice printer, but let's say it costs $500, right? That's a deduction because for the business, because it's a business expense, you're never having to pay that back, right? But what does a 401k, an IRA, or any tax deferred accounts do? When you deduct it from your income now, you're deferring it to the future. So it's kind of like you're taking a loan from the IRS, right? And what people don't think about in the future, taxes might be higher because something we talk about a lot on our podcast and lives is our tax brackets can go up depending on what the debt is. So if you're among the people that think the taxes are going to be lower in the future, you have nothing to worry about. Your Social Security income is going to be good. Your income that you get out of your retirement accounts, you're not going to be taxed on that much. You're going to be in good position. But if you're among the people like we are that believe taxes are going to be higher in the future because national debt right now is 35 trillion and going up, right? So the only way to pay that down is by increasing taxes. We're probably in one of the lowest tax brackets we've ever been in our American history. And for most of you that have been watching us for a while, we've talked about this in the past, is the highest our tax bracket has ever been is 94% in history, which is crazy, right? So if you're like us that believe taxes are going to go higher in the future, then you got to worry about, okay, how much can I take out of my retirement accounts so that, my tax bracket doesn't go up? I'm not in the higher tax bracket. And in turn, doing so, does that also affect my Social Security and how much I'm going to get taxed on that? Right. So those are all things to consider. So are you really in control of your money if you put money into tax deferred accounts? So something to think about. Anything you want to add to that or cover with that, Kyle?
Yeah, there's been, in the 6 or so years that I've been in this industry, I've always heard a constant, theme is that the tax train is coming. And 6 years ago, they were talking about the year 2026 being like the start of that. And if you guys don't know, and if you're, just tuning in, haven't heard of us before, we've talked about how in the year 2026, if nothing changes to the legislation and the rules around the taxes, tax rates are already going to go up about 2 to 4%, depending on whatever bracket you're in. And that's going to be just the start of it. The reason being, how does the government make money? They make money based on our taxes, individual taxes and corporate taxes. That's how the government makes money for their spending, in Medicare, Social Security, sending money overseas to fund our own military, and so on. The government makes money from our taxes. And what do we know about the government? Yeah, we're in almost $35 trillion of debt as a country. And how do we make up this deficit and this debt that we've kind of built ourselves in a hole in? Think about it. If you were yourself in personal debt, how do you get out of your debt? You got to make more money to pay it down or reduce your spending. And this is actually a really good point. For individuals, it's kind of hard to reduce or cut back our spending, right? It's much easier just to go make more income if you're an individual. Start a side hustle. That's why people are maybe doing Uber and other things on the side, right? The government doesn't have the ability to go out and start a side hustle. Instead, what they do is they just raise taxes. That's how they increase their income. Yes, they could cut spending, but what is the likelihood of them cutting spending versus just raising taxes? Well, the likelihood is that they're probably going to raise taxes because it's already in the plan for 2026 to happen. So, and these aren't just our thoughts. David Walker is his name. He's the former comptroller of the United States, which is basically like the former United States accountant or the CPA of the United States budget. He's come out and said that by the year 2030, taxes are going to have to double just for the United States to not go basically bankrupt, right? So taxes are already on the rise, and there's a lot of people that fear that taxes are going to have to get much, much higher. So with that, you do need to be in control of your money. And the basic level is just kind of initially understanding your personal P&L statement, profits and losses, expenses, understanding where your income's at versus where your money is going. What are you paying? What are your expenses even like? And this could be, as simple as just doing a budget. And majority of the people that I talk to haven't done a budget in years. They don't have any idea. They're happy if they see, a couple $100 left at the end of the month, and they're almost surprised if they see it, like they didn't expect it. Like that's how you know that you're not in control of your money. And anything that you neglect or that you don't pay attention to is using you and is going against you. And so with that, that's why we talk about controlling your money is so important. And that's the first step. It's kind of understanding where you're at. And then another thing that we talk about, is getting into business for yourself. If you own your own business, you can control your own income, and then investing, getting into assets and producing, cash flow that's outside of maybe your regular job or your regular business, but, diversifying and having assets that are having your money make more money. Right. And once you get to a position of that, that's when then you're in control of your money now, and you're going to be able to set yourself up for a much better future. And so with that, Renji, so we kind of actually mixed the two. We talked about, control your money now and later, which is okay,
Yeah.
which is cool. Right. Anything else that you want to add on and talk about? I can see that there's something you're thinking of.
Yeah. Well, so two things. When it comes to business, like you were saying, there's controlling your money in the sense of you can control how much money you make because of how much activity you do, how much money you spend on expenses to bring more income in and more cash flow in. And you can also, if you know how to read the tax codes and use the tax codes for your advantage, because like we said many times on this podcast before, the tax codes are set up to incentivize business owners, right? So if you know how to use the tax codes, you can control how much you actually get taxed on. So that's also there. But on the other side, if you're not into getting into businesses or owning assets or whatever, and just want to work because you love what you do and retire at 65 or whatever retirement age you want to retire at, then this is where what you put your money into comes into play, right? Roth IRA or cash value life insurance set up the right way. There's different things like that where you can control tax wise because you're paying all the money tax up front. So it doesn't matter what tax bracket you get to, doesn't matter how much your account grows, no matter what happens in the future, you don't have to worry about the government taking more of that money. Right. But, there's differences in those too. With the Roth IRA, you don't have control of the market either. So there's still there. You're giving up some control, but again, you don't have to worry about taxes at least, right? If you're contributing below that level, levels that they set, and if your income's not too high. If your income's too high, this is where cash value life insurance comes into play, because then you can contribute how much ever you want to. The importance there is setting it up the right way, because if you set it up the wrong way, again, you're giving up control, because setting it up the wrong way is where your money's going to fees and different things like that. So again, you lose control because you don't control how much your money grows there, right? So everything you get into, you got to think about, hey, how is this going to affect me income wise, first off? How is this going to affect me tax wise, second off? And then how much control am I giving up, right? So something we talk about a lot is the 5 principles to look at for when you put your money where you want to put it. What are the 5 principles? You want to go into that, Kyle, a little bit, and then we can go back and forth on that.
Yeah. So the 5 principles are safety, liquidity, rate of return, taxation, and fees. So safety, how safe is your money to wherever you're going to put it, right? Liquidity, meaning how easily can you access it and how easily can you get to your money when you need it. Of course, anytime you're deciding where to put your money, you've got to talk about the rate of return that you're going to earn on it, what kind of interest you're going to earn on your money. And then the 4th one, and probably the most important, is taxation. How is your money going to be taxed? Is it going to be taxed now? Is it going to be taxed later? Or is it going to be taxed never or tax-free? Right? And then lastly, fees. And price is what you pay, value is what you get. If there is a fee on a account or wherever you're putting your money, there should be extra value or benefits that come from that fee. Not just simply a fee to pay a commission of, somebody to like manage your money necessarily, right? So or to not provide any extra value, I should say. So those are the 5 pillars. And once you know and understand those, that's when you can, great point, that's when you can really control your money, because you're totally analyzing where you're putting it and what it's going to do for you, right?
Yep. Yeah. And going along with that too, think about the most basic place you put your money, in a bank, right? In a bank, you have safety. You know your money's going to be there. It's not going anywhere, right? Liquidity. You have access to your money. And how much you have access to, that again depends on how big your account is, right? Then there's rate of return. How much money is my money that I put in there making me? Most bank accounts, like we talk about a lot on this podcast, the banks are giving you less than 1%, depending on the bank you're with. On average, around the country, it's less than 0.5%, right? And then there's taxation. You're probably not going to get taxed on your bank account unless you have millions in there, which if you have millions in there, 0.5% can be a lot. So then you will get taxed on it. And then there's fees. Most bank accounts don't have a fee, but there are accounts that have a fee, but there's some type of value they provide for that fee that you're paying. So when you look at all of these 5 principles, let's talk about putting it into a business, buying an asset. If you're putting it into a retirement account, if you're putting it into a Roth, into personal permanent life insurance policies, whatever you're putting money into, you got to think about these 5 principles. Is like, how much of that is going to control where you're giving control to the government? How much control are you giving to others? Especially like Kyle mentioned, if they're managing your account, how much money are you paying them? And on top of that, if you're paying them a management fee, and you're paying taxation, and you're paying for the market losses, how much are you really in control, right? Something that a lot of people don't think about too with people that manage your accounts. If you're paying them 1% fee, what a lot of people don't think about, that fee comes out before tax. So you're paying them on your whole account a percentage of whatever your account is worth before you pay taxes. Right. So now after you pay them their management fee, now when you take out money, now you have to pay the government too. You're the last person to make money on it, technically, if you think about it, because the management people get their money first. Then the government takes their money to pay for Social Security, Medicare, different things that you pay for, you're the fourth person to get paid, right? So you got to think about all of that. So this is why Roth IRAs, permanent life insurance, cash value life insurance, starting your own business, all of these give you more control of your money because you're not worried about paying everybody else first before you pay yourself, right? Just some thoughts to think about. Anything you want to add to that, Kyle?
Yeah, I was talking to somebody the other day, and they had asked me why their financial advisor never told them about, switching to tax free and getting more money to be tax free. And now, he's at the point where he's getting ready to retire. So I simply told him he had about $1 million. So let's kind of do the math and talk through the situation together. This is a great point you just brought up, Renji. If he had $1 million and his financial advisor was charging him 1% to manage this account, and everything has yet to still be taxed on it, right? Every single year, his financial advisor is going to get $10,000 for managing this account. Let's say that he would tell, this is a different financial advisor though, is going to tell him to go to tax free. What happens when you try to then reposition your money and move it to tax free is because this $1 million has yet to be taxed, let's just take off 30% for taxes. Now that account balance, instead of it being 1 million, would be 700,000. For the consumer, yes, it's all tax free. You never have to worry about Uncle Sam again. Well, for the advisor, he just took his fee per year from $10,000 down to $7,000. And now this is just with one client. What do you think Wall Street is doing with their billions and trillions of dollars that is under their management? I think this is one of the biggest problems with Wall Street, and why one of the gentlemen that we work with used to be on Wall Street, and he talks about how he brings the financial strategies from Wall Street to Main Street to help people, get out of the tax code forever. And that when you get to retirement, the income that you take in retirement never shows up on your tax returns. You're never claiming that you're taking this income because it's tax exempt. It's tax free. You're never having to worry about taxes again. And then when you can get in a position of that where you're retiring in the 0% tax bracket and you don't have to worry about taxes, I mean, that's when you're truly in control of your money, to kind of bring it all full circle, right? Yep. You're truly in control of your money when you own it. You don't owe a portion of it to Uncle Sam. And by the way, what portion of that you owe to Uncle Sam isn't determined until you go to take out that money, right? So if you're in your 20s, 30s, and 40s now, and retirement's 20 plus years away, you don't know what portion of your net worth is going to go to Uncle Sam and to go to taxes. You don't know that until you get there and until you start taking out income, right? But if you're building tax-free wealth, you never have to worry about that, yep. Right? You never have to worry about the taxes. And then I think that kind of leads us into a financial strategy that I heard yesterday called buy, borrow, die. I heard of it a few years ago, kind of forgot about it, but when he said it, it brought back up. I was like, oh yeah, that's really good. It makes a lot of sense. I haven't thought to talk about that before on our podcast or anything, but the whole idea of buy, borrow, die is that you buy assets while you're young, while you've got time for working, right? You buy assets, you borrow from those assets, because anytime you borrow money, it's tax-free, right? You borrow from those assets to invest into other assets if you want, or for income. And then when you die, there's what's called a step up in basis. If you have brokerage accounts, if you have assets, etc., your assets can transfer tax-free to your heirs when you set it up properly. And then also when you die, you've got a life insurance policy that pays off all those debts that was existing. So when you follow this methodology and this strategy, you're reducing your taxes for the course of your lifetime. Because by the way, when you buy assets, you get a lot of tax deductions, which can actually offset some of your W-2 income or your business income. And you're controlling your money over the course of your entire life. You're reducing your taxes and you're passing on tax-free generational wealth, right? And that's how the wealthiest people do it. Like this is their secrets, right? And it's not really a secret. The information's been out there. You're just not aware of how to actually execute it and how to do it. But it just takes education and then just taking the action and doing it,
Yeah. And going along with what Kyle just said, like we love talking about real estate, right? So let's say you bought a property for rental. Now you have a huge tax deduction right there, right? You could deduct the value of the house over 27 years. That's one thing. But then there's something called FF&E, for all the stuff that's inside the like the land, all the stuff you bought the house with, everything that's inside. Let's say there was a fridge or a washer, dryer, any furniture, all of those things that you can write off, and that's a big tax deduction right there. And then on top of that, you can build that cash value. You're getting cash flow every month, right? After all your expenses and stuff. And then once in the future that property's paid off, now you're getting cash flow without any debt. But like Kyle mentioned, let's say you took out the value, the equity you have in that to go buy another property. That loan is tax free because loans are not taxed. Now you have two assets for the same value, right? And you keep doing that. Let's say you bought one property every year. You're adding to your income every year. That's something you can control. And then now, if you had enough life insurance, this is where we talk. Like I talk about this a lot, where I have a bunch of term on myself, and the reason is we have rental properties. So we've leveraged that to buy more assets. So now when I pass away, my life insurance would pay off all the mortgages, so my wife will never have to go back to work and she can live a passive income life. So I'm not only controlling my income and taxes now, I'm also controlling it for my future when I'm even gone. This is where setting up trusts, setting up wills, all this stuff come into play too, because if you do it the right way, you can control your assets and your business and everything, even after you're gone, right? So how much, again, we say all this to say, how much control do you have on your assets, your money, your taxes, your income, everything, and how much are you giving up, and how much of that will you control even in the future?
Absolutely. Awesome. So with that, hopefully you guys got some value out of this and, understand better how to control your money, not only now, but also for your future. That way you can build the generational wealth, create the financial freedom that you want and that you deserve, right? And then these are just some of the strategies to be able to do that. So thank you guys for watching. Be sure to like and subscribe to our channel. Leave your comments below. Let us know what other questions you guys may have or any other ideas that you may want us to cover for future podcasts. And with that, hopefully everybody has a great rest of your day, and we'll see you guys on the next episode. Take care.